Hello, everyone. This is Pam Seifert. Welcome to Reman Wholesale's winning sales strategy in a raising rate environment. Just a couple of housekeeping rules. Just to let everybody know, we have all participants on mute, and that is to limit the background noise so everyone can hear. Questions should be asked in the webinar panel. There's a question box right there. Unfortunately, there's a lot of people on the line right now, so we will not be able to get to the questions. However, we captured all those questions, and the Q&A plus a copy of this presentation will be sent out to all the participants once the webinar has closed. At this point, I would like to welcome Carl Markman, who is the Director of National Sales for Reman Wholesale.
Thank you very much, Pam, and thank you everyone for attending this call today. Like Pam has stated, this is probably one of our best attended webinars in a while, and I think part of the reason for that is all of us are dealing with the same issues out there. Compressing margins, right? I'm sure everyone understands that. The lack of refinances that are out there, and also the lack of listings out there. So all of us are fighting over the same loans, and one of the topics that always comes up, has always been in the top of everyone's mind for decades now, are rates and competing against one another. But I think it's even today more in front of all of us because of the lack of transactions out there. So winning sales strategies in a rising rate environment, I think, attracted a lot of you on this call. We're lucky to have our National Director of Renovation Lending, Steve Marshall, with us today. I'm going to hand this back to Pam just for one moment. She just wants to ask one question, and then we'll hand it off to Steve. Oh, I'm sorry. We decided we're not going to ask a question. We're just going to get right into it. This way we won't waste any time. So I'm just going to introduce Steve Marshall again, our National Director of Renovation Lending. Steve, are you there?
Yes, sir.
Excellent. So I'm going to allow you to take it away, and we'll be back to talk to everyone once Steve is done. Thank you.
Thank you, Carl. Hey, I just would first like to thank everybody for taking this 45 minutes out of your busy schedule today. And my objective with this webinar is not to teach anybody a quote product. Notice the title is Winning Sales Strategies. So my goal and objective really is to maybe challenge the way in which you think about a specific product or concept, but most important is to give you an important idea or concept that you're going to be able to implement in your daily sales activities to make you more money. All the knowledge in the world is worthless if you can't figure out how to implement it and not be able to understand the benefit that it has to you and your referral partners. So with that in mind, Pam, I would like to get started with the next slide, please. I don't know how many of you all read a lot of the industry periodicals. I do research every day, and sometimes it's very depressing. And it doesn't take a whole lot of research to realize that the number one obstacle that we have in our industry right now is what I coined the affordability issue, the affordability concerns. What we have is this situation right now where we have an extremely limited inventory of existing homes. And today, on Mortgage News Daily, there was an article that was published that said that in the new construction environment, that permits are significantly less, and that the cost of the material and the shortage of laborers might even contract that market. There was an article that was written several weeks ago, about 3 weeks ago, that literally stated that the inventory of existing home sales is the lowest it's been in 18 years. It's the lowest it's been since 2000. And the number that they threw out that there was a 3.8 month supply of existing houses in the market. and the typical historical number has been 6.4. So that's almost half of what the historical number is. And the area which had the least amount of existing home sales was the inventory that would be considered in the price range of first-time home buyers and entry-level market individuals. So how do we combat these obstacles of limited inventory, increasing interest rates, and affordability concerns? That's going to be what I'm hoping to stimulate your thoughts for the rest of this webinar. So let's move to the next slide. Here's what I think Remon's solution is. I used to be the director of product development for a very large organization for approximately 9 years, a little over 9 years. And so my objective was not only to develop proper product, but also to design sales strategies and teach people how to sell it. Well, the Fannie Mae HomeReady product, this product has been around for 2.5 years. It actually replaced the Fannie Mae old My Community program in the fourth quarter of 2015. Both Fannie and Freddie, as well as FHA and VA and USDA, matter of fact, all the GSAs, have been mandated by the federal government with a plan called the Duty to Serve. And the Duty to Serve is a mandate for 3 years, 3 of the fiscal years. And it's really for the lending community to focus on low to moderate income expansion as far as housing is concerned. And Fannie Mae looks at HomeReady as their #1 target. So with that being said, I'd like for Pam to move to the next topic. And why would we sell this product? That's the key: selling solutions, selling strategies in a rising rate environment. Number one is that the focus of what I want to teach everybody today is not about interest rate. It's about monthly payment. I don't know how many people who are out there in the audience today that sold the Alt-A product and what I'm going to classify as B paper or subprime products back in, let's say the 1996 through the 2006 time frame. But if you remember, if you did sell it back then, remember it had nothing to do with interest rates. It had everything to do with monthly payments and cash flow. And I believe that the principle is exactly the same today. When these periodicals in our industry are talking about an affordability crisis, and that's a word that they're starting to use, that it's become a crisis situation, they're not talking about interest rates. They're talking about the affordability, the ability of potential home buyers to be able to make the monthly payment on their mortgage payment. And so what the Fannie Mae HomeStyle does for us, or not the HomeStyle, but the HomeReady, is it actually, because it is their initiative for the Duty to Serve plan, it actually gives the borrower better pricing. And remember, I said it wasn't about price, but I'm going to get to that. But it gives them better pricing because the lenders are not charged loan level pricing adjustments for any loan with an LTV above 80% and a credit score above 680. And the average price improvement is about 75 basis points. It can be as high as 125 basis points if you have a credit score between 680 and 719. And that's what we're really going to focus on today: how to capture that benefit and really turn it into a wow kind of a situation. One of the things that I've always struggled with in sales was, how do I differentiate myself from everybody else out there? Everybody seems to follow the pack. And in this situation, I think that first-time home buyers, matter of fact, most home buyers prefer to have a fixed rate option. They only gravitate towards adjustable rates when they perceive that the fixed rate programs are too expensive. And my objective today is to dispel that myth utilizing this product. So let's go to my first example here. All of my assumptions, when I priced these out earlier this month, my assumption is in all these examples is that we had a buyer or borrowers that had the ability to put 5% down. I'm not using the example of what most people think of when they look at the Home Possible and the HomeReady product as, attacking FHA. And the reason why I'm not doing that is right now FHA is about 28% of the market, where insured, conforming, conventional business right now represents about 65% of the market. So if we're really going to really try to accelerate our sales, I think capturing a bigger percentage of 65% of the market is going to be more rewardable to us than trying to capture a percentage of 28% of the market. So here's my first example. We got a borrower who's buying a house for $275,000 and their credit score is 687. They have the ability to put 5% down. So on the first example there to your left, I just showed what everybody who's ever been in the mortgage banking business has been taught. Do a 95% regular Fannie Mae loan with regular monthly MI. It's the simplest, most standard product that everybody sort of gravitates to. Well, the day I was pricing this out, for somebody with a 687 credit score, putting 5% down, the rate was 4.99%. Now remember, on a standard 95% LTV, I got 30% MI. So the monthly payment of principal and interest and mortgage insurance was $1,636.03. It's very simple. It was real cut and dry. Well, I looked at this product, at this same situation. I said, well, what would happen if this borrower qualified for the HomeReady feature? Well, instead of my rate being 4.99, look, my rate is 4.625. Instead of my mortgage insurance being 30%, it's 25%. And because of those two components right there, my monthly payment is $1,547.85. Simply by thinking outside the box and suggesting using the HomeReady product instead of the standard Fannie Mae product and doing nothing else has saved the borrower $88.18. Well, that looks really good. But what we're going to do is we're going to go to the next slide to see what I consider to be the rest of the story. If we go, Pam, if you go to the next slide, please. If we go and we take a look at the same transaction, $275,000 sales price, we have a credit score of 687. Remember, the borrower had the ability to put 5% down. And they qualified for the HomeReady as far as the income limits is concerned. So here's what I'm going to do. What I'm suggesting is that we buy the LTV up from 95% to 97%. We also buy the interest rate up. Remember, on the last slide, the interest rate was 4 and 5/8. It was 4.625. In this slide, what we're going to do is we're going to buy it up 0.25%. We're going to buy it up to 4 and 7/8. That's going to give us an over par pricing situation, so that the combination of the over par pricing, buying it from 4 and 5/8 to 4 and 7/8, plus increasing the LTV from 95 to 97. Those two components allows me now to buy out the mortgage insurance by paying a one-time single premium MI. So what I'm going to do is I went to Radian, and I had to pick a mortgage insurance company. So in all these examples, I used Radian as simply as an example. I'm not necessarily, endorsing Radian, but I needed to pick somebody to use. So all these numbers are based on on the Radian charts. But by doing that, I can buy a 25% refundable single premium MI by combining the 2% higher loan amount and the buying up the premium as far as rate. So the cash for closing in both these examples, both the 95 and the 97, with the elimination of the mortgage insurance by having the single premium, the cash to closing at the settlement table for the borrower is exactly the same. But look what it does to that monthly payment. The monthly savings is now $224.18. On our previous slide, it was $88.18, and that's a wahoo. That's a real benefit to a borrower. But now, by taking this one step closer, we've now enhanced that savings from $88 a month to $224 a month. Let's go to the next slide, Pam, and because now what we're going to do is we're going to talk about what I sort of classify as the equity builder concept. To me, we're out there. We're buying leads from people. We're calling on realtors. We're calling on financial planners. We're calling on builders. One of the things, especially what financial planners and realtors like, is the idea of helping somebody build equity. So what I'm talking about is how about if we ask some questions? How about if we ask borrowers about were they looking to retire in the next 10 years? Or what about if they had small children and if they've ever given any thought about the college tuition that they were going to have over the next 10 years? Ask the questions, listen to the responses, and then design a personalized mortgage plan to meet the specific needs of that clientele. In this example, what I did is I took a look at a client who had the ability to make the normal payment at the 95% LTV standard conventional loan. But I took the savings of the last slide that we saw, the $224 a month savings, and I showed them a plan where if they made the exact same payment and took that $224 a month and applied it to the principal balance, therefore accelerating the prepayment of that principal balance. Look what it does. On a regular standard Fannie Mae, at the end of 5 years, the borrower owes $239,465. And at the end of 7 years, they owe $229,264. Now, some people might have thought that when I increased the loan amount and the LTV from 95 to 97, that would have an adverse impact on the borrower's equity position. But by making those additional principal payments, by giving the borrower that flexible option, if they chose to accept that option and make that additional $224 a month payment that goes directly into accelerating the reduction of the principal balance, at the end of 5 years, look at what their principal balance is. $228,614. That's $10,851 more in equity utilizing the HomeReady with the no MI concept than under a regular standard Fannie Mae. Now, take it out to 7 years. At 7 years, your principal balance in this example is $210,827. The borrower has an additional, not total equity, but has additional equity of $18,437. So if in this transaction, you help this borrower purchase that single premium And remember, our single premium was a one-time premium, upfront premium of a refundable program. So at the end of 7 years, your LTV now represents 76.7% of the original sales price of $275. So your borrower actually will not only have a savings of the $18,437, they're actually going to get a rebate from the mortgage insurance company because they prepaid the balance here, and now they can cancel that MI. That's some pretty powerful stuff. I mean, what you've literally done in this particular case is, instead of just being, a loan officer, instead of just being a salesperson, you've become a trusted advisor. You've actually shown them a personalized plan for them. And you've given them options. Now, they might not choose to take that option of making that additional principal payment. They might take that $224 a month, and they might prepay a car payment or a credit card or some other type of consumer debt obligation. That's okay, because you're the one that facilitated their ability to even get to that point in time. Let's get to the next slide, because now I want to talk about our referral partners. Taking something like this to our referral partners and show them how partnering with you and the product knowledge that you have relative to this situation can help expand their business. Because the more you can help expand the business of your referral partners, the greater value you bring to the transaction. So with a Fannie Mae HomeReady product, let's just say we used a consistent 43% debt-to-income ratio. Let's just make that assumption, that the debt-to-income DTI that we were going to use for both the standard Fannie Mae and the HomeReady was 43%. By actually lowering the monthly payment, that means that this potential borrower would require $6,256 less in qualifying income. That is huge. That means that there's more potential borrowers that are able to come in to this situation and purchase that property, because by you just reanalyzing this transaction, offering the HomeReady, buying up the LTV, taking that savings, doing a single premium MI, eliminating the mortgage payment so that the borrower has this huge monthly savings as far as the payment is concerned. To a listing agent or to a buying agent, what that means is that there's a population of people that can go through and purchase these houses. So for a listing agent, look at that second bubble. To them, that means they can advertise this and increase the foot traffic into their listings and give them a better opportunity to pick up referrals from potential borrowers coming into their listings who are what I'm going to call orphaned borrowers because they don't have a buyer's agent with them. Fannie Mae did a survey of home buyers, and I was actually I was privileged enough to be part of this lender focus group. There were 7 lenders, and we were one of the lenders, and myself and our chief credit officer were the participants for the organization. And what they shared with us was that first-time home buyers, or really millennial buyers, not just first-time home buyers, but millennial home buyers, they asked them who did they rely on the most for recommendations and ideas about the home ownership process. And you know what? I would have thought the realtor, I would have thought us, the lender. That wasn't true. They relied mostly on friends, family, and coworkers. So then the Strathmore Corporation did a survey, and the survey essentially was very similar to the Fannie Mae survey, but it just wasn't for millennial home buyers, it was for home buyers in general. And their survey showed that 18% of the people who went to a lender, went to a loan officer, the reason why they went, 18% of them ended up with that loan officer, was because they were referred to them by friends, family, and coworkers. So the more we're able to satisfy not only the immediate need, but also a potential long-term need for our home buyers, the higher the probability that they're going to recommend you to their friends, family, and coworkers. And if the Fannie Mae survey and the Strathmore Corporation surveys are correct, that means that's going to put you in a better competitive position to be able to capture more referrals, simply because you're satisfying the needs of your existing home buyers. With a buyer's agent, that last bullet, you got more purchasers. They need less income, so you got the potential for more purchasers. But the really big thing is especially for the buyer's agents, is you literally are minimize, and you're never going to eliminate, but you're going to minimize the whole idea or the whole concern about affordability, because you're reducing their payment. Now, notice in my slide where I bought up the rate to 97 and we bought out the MI, it wasn't about the interest rate. It was about the payment. The borrowers are focusing on, here's my cash flow, here's my debt structure on a monthly basis. Do I have the ability to afford this house? And simply by thinking outside the box, asking a few questions, and doing a little research, this is probably one of the most powerful tools that I've seen in a long time. So let's go to the next slide.
Steve, I just want to interrupt for a moment here. This is Carl again. We're getting a lot of questions here, so this is really good. Just want to give you a time check. We're about a half hour in, so just kind of want to let you know as we move forward. But a lot of really great questions. Thank you.
All right, next slide. This is not a bond program. It doesn't have to be for first-time home buyers. Matter of fact, the borrowers can currently own properties when they close. Income limits are 100% of the median income. However, 31% of all the census tracts in the United States have no income limits. And one of the big things that we see in my examples is that it does offer the special MI of 25% versus 30 and 35% coverage. And that borrowers do not need home counseling. They do need home buyer education. And the home buyer education does not have to be complete until closing. So it's not like they have to do it prior to signing a contract. The next slide that we have talks about the special MI feature, because I think this, whether you do it the standard way or you do the single premium, the fact that you're getting 25% coverage instead of 30 or 35% coverage is significant. And if you do a refundable premium, I have been told, now I'm not a compliance expert, but I've been told if you utilize the refundable premium, that it is not considered in the 3% high cost calculation. The next slide that we have, Carl and Pam, shows 10 of Remon's top states in which the percentage of census tracts are above the 31% national average that don't have an income limit. Alabama, Arizona, California, Connecticut, DC, Georgia, Illinois, Maryland, New York, and Tennessee. The next slide that we have is a lookup How do you know whether the borrower has the income to qualify for this? You go to Fannie Mae's website, fanniemae.com/single-family/HomeReady. And if you have the property address, it's real easy. You just plug in the property address. If not, you can select a state and then a county. I did that in New Jersey. Our corporate headquarters is in New Jersey, and I selected Mercer County, New Jersey. And half of the census tracts in Mercer County have no income limits. The other half have $95,400. So the next slide. Know your niches. The note that I have right here is whenever you go to these motivational sales presentations, they're always trying to sell you something. They're always trying to tell you that you need to invest in your business. What I'm trying to present to you right now is, yeah, I think that you need to invest in your business also, but not money. I think that that in this particular case, if you invest some research and some time really to understand the mechanics of this product from a pricing benefit point of view, you're going to really be able to expand your potential networking by marketing to listing agents. And the reason why I say that is the following. Your listing agents have specific properties. You know exactly what the address is. All you have to do is go to your agents and get an inventory of their listings and plug it into Fannie Mae's census tract calculator, and it'll tell you what the income limit is and or not have income limits. I did that right here in Annapolis, Maryland. I'm calling you from Annapolis, Maryland. Our office is located in zip code 21401. I live in that same zip code about 4.5 miles away. The income limit for the address right here of my office where I'm calling you from is $91,100. The income limit where I live 4.5 miles from here, no income limit. So simply by putting in the actual property address gave me the specific income limit. All you have to do then is approach these listing agents and actually ask them, or not even ask them, put together a mortgage payment comparison chart, put together some marketing flyers and some open house flyers, and really help those listing agents facilitate the sales of those properties. And you have definitely distinguished yourself from the competition. So as far as homeowner education, on the next slide, I know that this is a confusing thing. Most home education programs have to be done before somebody signs a contract, and it has to be done with all of the individuals who are purchasers. Not the case with the HomeReady product. The HomeReady product can be done as an online education feature. Only one borrower in the transaction has to take the education. It is available both in English and in Spanish. It only has to be completed prior to closing, and the cost is $75. Let's go 2 more slides. I know we only got a limited amount of time. Right there. Yeah, that's what. All right, as the National Director of Renovation Financing, I couldn't help myself. I had to put something in here about renovation. So here's what I did. I used an example. $275,000 sales price. Same kind of sales price that we used in the other examples. In this particular case, the borrower wants to do $50,000 worth of renovation work. So I compared a Fannie Mae home style at 95% LTV to a 97% LTV HomeReady reno using the exact same concept of buying out the MI. Look at the difference in the monthly payment. $211.94, almost $212 a month. It's the same borrower buying the same house, putting the exact same renovations in together. The only difference is that we've used our education and information knowing that this borrower's income qualifies for the HomeReady restructured the transaction, and we saved them $212 a month. Now, why is that important? We go to the next slide, I'll tell you why it's important. One of the biggest obstacles that we have to overcome in the world of renovation is people think it's too expensive. So take a look at a borrower buying a regular house for $325,000, getting a regular 95% LTV conventional loan, putting 5% down. Monthly payment is $1,875.70. But how about if that same borrower did what we just did on that last slide, where they bought a $275,000 house, they put $50,000 in repairs so that the acquisition cost is the same $325,000. They used a HomeReady product. We bought it up to 97% LTV, bought out the MI. Look at that monthly payment, $1,740.80. The monthly payment is actually $134.90 less doing a renovation loan than it would be to do a non-renovation loan. So the last slide, in an environment where people believe that affordability is at a crisis level, what we've done is we've helped people overcome that crisis. What we've done is been able to utilize the information given to us on the web through Fannie Mae's website, being able to plug in either census tracts and or actual property addresses, and then target market real estate agents and potential home buyers that meet that classification, and literally present them something that I tell you what, your competition hadn't even thought about. This is a way that you have an opportunity to distinguish yourself from everybody else in your marketplace. So, go 2 more slides, and then I believe I am done. Carl?
Thank you so much, Steve. We appreciate all of your insight. I actually picked up a couple things as I'm listening to you as well to reach out to my account executives to talk to their customers. Again, thank you so much, everyone, for joining in this call. We had a very, very good showing this time around. A lot of questions, but there are many questions that came up, again, revolving around, are we going to be sending out the presentation, everyone? Anyone who registered for this call, this webinar today, will be receiving this along with a Q&A afterwards. I also want to make sure that everyone understands this is not the only product that Revit Wholesale has to offer. We have all of the product mix that everyone else has out there, the Fannie, Freddie, VA, all the different types of products, USDA, and so forth. Funny that Steve, our renovation national manager, had mentioned renovation. We just introduced a great product, a VA renovation product as well. If anybody is interested in learning more about our products or services, our same-day turn times every day for over 2 decades now for the initial underwrites, please reach out. Go to our website, reach out to us. We'll be more than happy to discuss that. But again, thank you so much. A lot of people didn't make this webinar because it was just a lot of people wanted to get on here. So thank you so much, and have a great day, everyone. Hopefully you learned something today. Thank you again, Steve. Appreciate it. Bye-bye, everyone.